Hello everyone, welcome back to your chapter 5 session. So here we're going to continue with the consolidation. Chapter 5 is focused more on what happened after the business combination. So we know that under the IFRS rules, if there's the parent purchased a subsidy and there's a control involved, you're required to consolidate financial statement on annual basis. So what do we need to do after the acquisition for financial reporting when we consolidate both the financial statements of parent and subsidy? So we are going to look at the example that we have in chapter 5, and I will try to see if I can walk you through the PowerPoint slides so that we understand what happened if the consolidation was happened at 100%, and then what if there was a not 100% but 80% or anything that still makes the company have a control, and then how do we recognize the NCIs and then do the consolidation if there's a business combination that is less than 100%. The first example that we're going to look at is a consolidation at 100% owned subsidy. So if you have your textbook, what you can do is you can refer to the example that we have in the textbook on page 218. So that's what I'm going to use when I'm going to demonstrate these numbers. So first we need to understand what happened at the consolidation at 100%. So what we do is when we do a consolidation, the intercompany's accounts gets eliminated. So the investment accounts are replaced by the carrying amount of subsidies, assets and liabilities plus any acquisition differential does exist in the company. And the purchase price consists of the amount of subsidy and asset plus the acquisition differential. So that's something that we determine in the first step when the business combination does happen. And then if there's any intercompany transactions that also need to be eliminated. So dividend received or receivable from the subsidy are recorded in the parent's income when the cost method is used. Now these dividends need to be eliminated for the consolidation purposes. And later on you guys will definitely going to get into where you have other transactions also between the companies which are other than dividends, and now for the consolidation purposes all those transactions need to be eliminated. Then once we eliminate those transactions, then we will start working on the consolidation. So when we do a consolidation, then there is an acquisition differential that does exist on the working paper, not on the parents or subsidies book. Now those, if there is any assets that has to be tested for the impairment, if there's any amortization of certain assets that exist, for those ones we do need to do the calculation to lower down the acquisition differential on the consolidation level. So if there's an amortization or impairment of the acquisition differential is recorded at the consolidated financial statement in order to match the expenses to the revenue generated by the net asset acquired. The example of the amortization impairment schedule are as follow. Okay, so this is your schedule that you have to maintain. You will have a number that you will use carry forward from the business combination. Then what you do is you determine what happened at the end of the period, and if there's an impairment, you do an impairment loss. If there's assets that need to be amortized, then we will amortize those assets and record them at the consolidation level, and that brings your acquisition differential value down, and then you recognize those differences to P&L or the income statement. So consolidation, what do we do? Consolidated financial statements are prepared account by account. So when you do a consolidation, you do a line by line consolidation. The consolidation of net income and the consolidated balance sheet accounts are the same regardless of whether it's parent use equity or cost method. So the method used by parent to record the investment is not going to make any difference of how the consolidation will look like, because those transactions will be eliminated regardless of what method they use. Dividends on the consolidated statements of retained earnings are dividends of the parent. If there's any dividends that were paid out from the subsidy, that never gets reflected in the retained earnings statement. The retained earning only shows the retained earning for the parent company. Consolidated earning reflects the cumulative effect of all the adjustments to the date. Obviously that will have all the adjustments, but the dividend amounts are going to be only the dividends issued by the parent. The consolidated financial statement represents the combined portion of parent and subsidy as if parent has acquired the subsidy asset directly. Okay, so it's 100% consolidation. So here is the example that we're looking at on exhibit 5.5. So we are given the company parent's financial statement, company P and company S, and then we are preparing the consolidated financial statement using that information. So when we're doing a consolidation of income statement, what we're doing is we're taking the numbers from the parent, we're adding the number from subsidy, and if there's anything that we're doing at a consolidation level, such as acquisition differential, need to be written down. For amortization or any impairment, we will add or subtract those numbers as well. Okay, so in this example, there's only two things that's happening. One, there's a goodwill that was recognized when we did the impairment. When we did the acquisition differential, that $2,000, which obviously inventory is always reversed back in the following period. So if this was increased in the previous period, that need to be decreased in this period. If it decrease, obviously that's gonna add up your cost of goods sold, because that is the beginning inventory of that company, and that was the ending inventory last period becomes beginning inventory for the following period, and that beginning inventory definitely increase your cost of goods sold. Okay, and then there's an impairment of $50 on a goodwill. So those things would have been done separately before you come into the consolidation level. So they already did that calculation and told us that these are the two things that need to be reflected on the consolidation level. So now when we do a consolidation of the income statement, we look at the sales for parent, sales for subsidy, cost of sales, same thing for parent and subsidy, plus the 2,000 of the acquisition differential we're writing off. Goodwill, there is no impairment on the parents and subsidy, but we are writing off the impairment of $50 on the consolidation level. That goes up here. Then your miscellaneous expenses of parent and subsidy, and then we add that, put that amount there, and then we calculate the net income on a consolidation level. So you see that note at the bottom here is the consolidation net income is the same regardless whether you use the cost or equity method. So it doesn't have any reflection of that when you do a consolidation. So then we look at the retained earning. So retained earning, we look at the retained earning that company has at the beginning. So this is again done at the consolidation level. So when we did the financial statements at the business combination, we know how much was the retained earning, which is the same as the parent's retained earning. And then now the net income that we have here is not the net income from parent or subsidy. We take the net income that we calculated from this statement. We add that here. And then we take the dividend. So now remember what I said initially. The dividends here are the only dividends that are paid out from the parent's book. So any dividends that are paid out by the parent are only reflected in the statement of retained earning, and then this becomes your ending balance on December 31st. Okay. Now we're going into the balance sheet. So now this balance sheet, we do the same thing as well. Now you're going to look at, after you did the impairment losses or any amortization of the acquisition differentials, then what you do is you will have to reflect that and see what your numbers were on the consolidated working paper, and you add and subtract those numbers as well. So this example was pretty stable. We don't have much numbers, but what you do is you look at the number on the parent, your number on the subsidies financial statement, and if there's any assets that you recognize at the time of business combination, if there is a value there, you will add those numbers in here as well. So in this case, we only have two numbers. One was inventory, another was a goodwill. The inventory is written down to 0, so there is nothing for us to add here. The goodwill was $1,000, and we did an impairment of 50. The value that we have on our working paper was only 950, so we added that amount right here. The total amount we have is $211,050. Then we do the same thing with the liabilities, and for the common share, these are the numbers for the parents only. Okay, so now there is no NCI, so we don't need to do anything for NCI because this was 100% on subsidy. So now when it comes to the consolidation, this is just a note for you guys. When the parent used the cost method to determine the account for subsidy, the net income has been allocated by converting the equity method net income, since the equity method reflects all the consolidated adjustments. So if you were to do the consolidation or calculate the net income using the equity method, you will come up with the same result. And this is what I was trying to say. If you use your cost method, you said you have 20,000 of 800, 20,800 of your investment. You subtract the dividend. Remember, when the company pays dividend, what you do is you take it out from the investment account. So this becomes your investment balance. Then you look at the net income, which is 7,300 of the subsidy, because this is 100% owned. So you add the full amount. Then you also look at the acquisition differential that was recognized, and then what you do is you take your portion, which is the full amount, and you subtract that out, and that left your net income to be 5,250. Then you add that to the parent's net income, and then you combine them together. This is your consolidated net income. So you see that when you do a consolidation, even if you don't want to do a line by line, you can just use this method and reverse it back, and that will come up with the same amount. Okay, so in this example, the company was using cost method. That is why the dividend that was received was recognized as an income. So what we did, we reversed that dividend out because it was recognized as a net income. It was part of that. So we reverse that out. That shows up your investment, your income for the parents. I was sorry, previously I was saying it wrong. So this is actually the net income for parent as of that year end, and then we subtract out the dividend that was part of this, because intercompany, remember we said intercompany transactions need to be eliminated. So when we eliminate that, then we only have 18,300 of net income. Then we look at the subsidy income, we reverse back the acquisition differential, and that gives you a net number. You combine that, that is your net income. So now if you go look at the net income that we produce here, numbers are the same. Okay, so that is when you have 100% ownership on the subsidy. Now we're going to look at the 80% ownership. So when you do an 80%, then what happened is you have an extra step that you have to do. So that extra step is the NCI. So everything that you're going to do, you have to do a calculation for NCI as well. Okay, so in this case, what we do is we're using implied method for the calculation of the NCIs. So the cost of company company S that was paid was 15,200 to acquire 80% share. So the implied value of company S is 19,000. How did we get that? 15,200 divided by 0.8, that gives me an implied value of 19,000. We allocate that between the assets and find out that we have acquisition differential of 3,000. We allocate 2,000 to inventory, and the 1,000 goes to your goodwill. Then we do the NCI calculation, and we know the company value was 90,000. 20% of that belongs to NCI, so NCI is 3,800. Now when it comes to the consolidation, so although parents owns less than 100% of the subsidy, 100% of subsidy individual assets and liabilities still reported on the consolidated balance sheet, since they are controlled by the parent. So now there's no changes in regards to how the consolidation was done previously, because what we're doing is we are consolidating at 100%, and anything that doesn't belong to parent, what need to be done is their portion need to be allocated to the NCI. So that way when we do a consolidation, we will recalculate the NCI, see what the opening balance was, any adjustment that happened that doesn't belong to the parent, belongs to NCI, gets allocated, and the NCI amount will show up on the consolidated financial statement as part of the equity. So here is an example. So we did the same thing. We look at company P's income 20,000, and we take out the dividend, right, which was $2,000 from the company, which is reversed back, and now the company net income, which is just from its own operation, is 18,300. Then you look at the company S net income, which was 7,300, and then we subtract that out from the parent's income. So you add that with the parent's net income, your consolidated net income becomes 23,550. So this is at a 100% level. Then what we do is, this is the same number that we calculated previously. Now, because this is not owned 100% by the parent, what happened there is that we allocate 20% of that amount to NCI. So the shareholder, the P is 22,500, and then from this value, because this was the net income for the subsidy, because you don't touch subsidies net income, you don't touch parents net income, the NCI will get 20% of this net income that's allocated to the NCI. Okay, so 22,500. How did we get that? That is 80% of this number plus 18,300. This gets allocated to parent, and then 5,250, 20% of that belongs to NCI. That gets allocated to NCI. Then the consolidated financial statements are prepared account by account, starting from the consolidated net income, then the retained earning, then finally the balance sheet. Consolidated net income is attributed to controlling shareholders and non-controlling shareholders. Non-controlling is interest. NCI is shown up on balance sheet as part of the shareholders' equity. This increases when the subsidiary earns income and decreases when the subsidiary pays dividend. So the NCI only gets reflected with two things. One, it gets reflected with the net income, which is the adjusted net income of the subsidy after applying the acquisition differential. And then if there's a dividend paid out, that gets subtracted from that NCI as well. Okay, so those are two things that gets reflected in the NCI calculation. So here is your consolidated net income, exactly what we did previously. Now we're doing it more of a formal way. We will look at the consolidated numbers and then allocate that and say this is your consolidated net income. Then from here you need to allocate that between company P, which is the parent, and NCI. So company P will get their own earnings, which we calculated previously, plus 80% of the subsidies net income that gets allocated to company P, and the NCI only gets 20% of the subsidies income plus or minus any acquisition differential. So this calculation definitely helps to determine how much is going to go to NCI and how much is going to go to the company P. So this is definitely need to be done before you do the consolidation of the income statement. Then when it comes to this retained earning, we look at the opening plus the net income and subtract any dividend that was paid out. So now if you guys notice this, that this was the income, but only amount that was allocated to the company P is 22,500. So when we're showing up the net income here, we only add up the amount that belongs to the parent company P. The NCI amount, which is 1,050, gets allocated to the NCI account, when that is also going to be part of the equity section, but that will show up as a separate line. And here's the dividends that were paid out. This was a dividend paid out from the parent only. And then, so this dividend was parent. Then we look at the balance sheet. Now for the balance sheet, what we do is we look at we're doing exactly what we did in the previous example. We add all the assets, liabilities, and then when it comes to the retained earning, we take the number that we calculated in the previous statement. And for the NCI, what we did was we calculated the amount already. Previously your NCI was 3,800, and then we allocated 1,050. We add that Then you 3,800 plus 1,050, that's $4,850. Oops, went too far. So 20% of 10,000 plus this plus. So technically, there's different ways you can allocate. We did 10,000 plus 10,800 plus the 950. So these are the values that is sitting there. So it should come out to the same amount, which is 150 plus. Okay, so I'm going to look at the example that we have here so I can see if there's anything that I'm missing. Okay, so what happened here is on the balance sheet, when we do the NCI calculation, the best way to do that is you look at the shareholder equity of the subsidy, which is actually on exhibit 510. So the common share for the subsidy is 10,000 and 10,800 for retained earning. And then you look at the 11C, which is exhibit 11C, that shows what the acquisition differential balance is on December 31st, year 5. You look at that number, so you add all those numbers because that is your value for the subsidy, including what's on the subsidies book, what's on the working paper as a value for the acquisition after you realize all the other accounts. What happened with that? So you take that amount and then 20% of that will be what's going to be allocated to the NCI. Okay, and that amount shows up right here. You add them together and that gives you your value of your the consolidated financial statement. Then the consolidation under the equity and cost method. If the parent has used a cost method, or you call the subsidiary and necessary to calculate the opening consolidated retained earnings, so it is required you do that, so that way you can reflect the cumulative increase or decrease in the subsidiary retained earning since the date of acquisition, because you have to reverse back all the events that happened. Reflected cumulative consolidated adjustment to that point where the acquisition differential gets amortized. So example will be the acquisition differential amortization. When the subsidy is less than 100% owned, it is necessary to calculate the balance sheet NCI. That is definitely going to be part of the consolidation. So if you're doing consolidation, there is less than 100%, you have to do the NCI calculation and show that working paper to come up with how did you come up with that amount. So this is your retained earning as of January 1st, year 6. So the company was using the cost method for that investment in P. So company P retained earning on exhibit 514 that we have here. So we had a net income. So we have a starting retained earning of 19,300 to start with. And the company asset retained earning was 10,800, and the company retained earning as per the acquisition date at the time of the acquisition was 6,000 only. So what you do is you look at the increase that you had in the retained earning from the date of the acquisition, which is the net increase of 4,800. And then what you do is you look at the change to the acquisition differential to the end of year 5. Because now what happened is on year 5, you calculate how much the acquisition differential you written off, which is 2,500. And then what you do is you take that amount, 4,800 minus the acquisition differential that existed, which includes 2,750. And company P's ownership on that is 80%. So 80% of 2,750 is 2,200. And then we have a consolidated retained earning of 101,500. Okay, that's how you will do the consolidated retained earning from the day of inspection. So you can use this template and plug in all the numbers that you have from the question that is given, and that will help you determine what the retained earning going to be if the company's P's, which is equal. Obviously this number is not exactly the same number if the company is using the equity method for recognizing those investments. Okay, but if it's using cost method, then you have to make sure you do this calculation to calculate your company's retained earning amount. And then what happened with the NCI? So you have to look at the NCI calculation on December 31st, year 6. And that one you have to do is you have to look at the numbers that you have on the company's financial statement. So in that case, you're always gonna, so exactly what we did in year 5, you look at the shareholder subsidies financial statement and look at the shareholders equity section, and you look at how much is the common shares and how much is the retained earning, and then you look at the working paper to see what is the value of the acquisition differential. You add all that number and look at the value for NCI, and that is 20% of that amount, and that will be your new number that you're going to use for year 6 for the NCI. And you follow it along to calculate your retained earning for the December 31st, year 6. So you do the same thing what we did previously. We start with company P's retained earning, and then we look at the retained earning we have for the subsidy on December 31st and the company S retained earning. So you always have to remember how much was your actual retained earning, and this is your net increase from year 5 at the beginning till the end of year 6, and that is your increase since the inspection. And then you look at the change in the acquisition differential at the end of year 6, which is 2,130. We just keep adding and decreasing as we record the acquisition differentials, and that is your value. And then amount that belongs to the parent is 80%. So 80% of that shows up your company's P's ownership, and that gets added with the retained earning of the P, and then that will give you the new amount for the retained earning at the end of year 6. And you continue to do that as you move along for the consolidation. Okay, so we're gonna stop at slide 39, and then after slide 39 I'll see if I can post a video before the next class that we have on Tuesday, so that way we don't have to go through those things. On Tuesday we can focus on picking up some homework question and wrapping up this chapter, and then we'll do a class on Friday which will actually more of a again focus on the same chapter, but we'll do more questions in class, so we'll have more time to complete this chapter. So what I'm going to do is I'll post this video that will cover up at least the consolidation part. And then there is other things that we need to cover, which is the acquisition differential using net identified assets, and then some of the other topics that still need to be looked at. So I have 10 more slides to cover, so maybe I will post a part 3 video of chapter 5 that will cover those topics. And then you guys, what you need to do for this week, if you have time over the weekend, read through chapter 5. So finish reading chapter 5. You don't have to get started with the actual homework questions. We can do that next week. Okay, so your primary goal for this weekend or up until the next class is to make sure you read chapter 5, look at the examples that are given in chapter 5, and then you can come back to the blackboard later on Monday or Tuesday next week, and then you will have another video that will wrap up the chapter. But just make sure you finish reading the chapter before you come to the Tuesday class, and then I'll see if I can assign the homework question as well, so at least you know in advance what you need to do. But again, that is not something that I expect you guys to do by Tuesday. So the only expectation I have from you guys is to at least read chapter 5 before you come to the Tuesday class. Alright everyone, I think hopefully this video will definitely help you, and then when I see you on Tuesday you guys can bring your questions from this chapter and we can discuss that at the beginning of the class, and then we'll jump into the actual questions. Take care everyone till then. Have yourself a great weekend. I'll see you in the class on Tuesday. Bye bye.